Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Scrolling through the comment section, I guess we're going to talk about debt. It says, nice stuff, Andy. Can you comment on what effect the immense level of government and personal debt could have on the thesis and what effect rising rates would have on those carrying high debt loads? Just talk about debt. Channel's awesome. Higher interest rates, even 25-point increase and spiking high energy prices sounds like a recession to me. Or will the government just spend us into a euphoria to things alive before it falls apart? Or are we going to get debt, high interest rates, massive money printing, the USD taking a 20% haircut? To get us another 10 times from here, I chuckled how Buddy's book you're quoting, he's hanging on for another few percent, and you're hanging on for a 20x on the top of your 20x. Point's still the same, I guess, and I agree with patience gets rewarded. But if you're not creaming some of that 1,000% gains to put it into physical or some other form or cheap stocks, there's only one word for that. And it isn't stupid. I'm ready for the next leg up. Let's go. So my viewpoint is interest rates chase inflation. They're not a driver of anything. So when inflation gets in the system, people sell their bonds. We just have an external buyer called the Federal Reserve buying bonds to hold the rates lower. It's an artificial manipulation game. And I don't think that recessions just come out of nowhere. I think that recessions come from a deleveraging. And my opinion is it comes from the real estate market. Before almost every single recession, we've had a deleveraging in real estate, which means the housing starts go down, loaning gets cut back, and then we've got maybe some problems with some of the loans that were in the system. Foreclosures, stuff like that, which is a destruction of credit. It's a deleveraging. So I don't think that interest rates at this stage of a real estate cycle going up 0.25 or 0.5 or 0.6% is going to do anything. The government is going to ensure that we have inflation at a greater rate than interest rates, which will mean we have a real negative rate. With a real negative rate, that means that your debt will be inflated away. So those who have the most amount of debt, aka the government, and remember, the debt is by design of the system. You can't get out of that debt. It is impossible. The money doesn't exist for the interest payments in the system. They know that. And we've leveraged up quite a bit in the system. There's a lot of debt. We need to deleverage the debt. They need to inflate the debt away. So whether that comes with increased loans from the real estate cycle, or they're going to spend it fiscally, or they're going to send checks out. If there's too much debt, they got to get more money in relationship to how much debt is in the system. Now, I own a fixed rate 30-year mortgage. I think a lot of people have fixed rate debt. So if the interest rates go up, all of those people would not be affected by the increasing interest rate. It's not going to matter. The inflation in the system and ever greater quantities of inflation with real negative rates is actually going to benefit those with the most amount of debt on a fixed rate debt. Any fixed rate debt, you're gonna benefit from it because inflation is going to eat that debt away. You're going to be able to pay the debt back easier than what you could otherwise. Now, I don't think that we can have a deflation. These guys that say, oh, there's a shortage of dollars. Well, just print more dollars. That's all they're going to do. And they're going to print like mad. That's my opinion. The deflationists will be wrong because we've never had deflation in any sort of long-term amount. And if we do, the whole system will collapse. So I think that we're going to continue the money printing, which we have to, and the debt will be eroded away. We are also in an expansionary phase of real estate, which historically has shown that the amount of credit and loans will go up. Now, is it going to be a smooth ride? No one knows that answer. Are we going to have a little bit of a pullback between the stimulus money and the loaning that comes from the real estate market? Very well could. I can't tell you the path that all this is going to take. I can tell you that when interest rates go up and we have a real negative rate, that is when precious metals, that is when a lot of these energy companies and commodities go ballistic. That's when they really start to take off because money rotates under an increasing interest rate environment. So rather than worrying about an increase in interest rates being bad and looking at a recession, I would view it as being excited and that the takeoff is about to happen. That's the way that I view it. There's a lot of misinformation out there that people think that increasing interest rates are bad for precious metals and for commodities. I disagree. I think they're actually good, so long that you have a real negative rate. But we have to have a real negative rate for that debt to be inflated away. So the market conditions are actually more beneficial to precious metals and commodities than it's ever been in history, because when you have a real negative rate and you have an increasing interest rate, it will literally force money out of stocks and bonds and go into where we're at. And if the government has to inflate the debt away, they will ensure that those market conditions, which are conducive for commodities and precious metals, exist because they have to exist in order to deleverage the system. So I think it's actually like they're stuck in a corner and they have to have increasing commodity prices and increasing precious metal prices based off the situation of the debt loads around the world. And I'm talking about just more than America. But America is where I focus because that's what the commodities are priced in. They're priced in dollars. And the value of the dollar, if we see that dollar really start to come down, which I think where all the pressure is going to mount itself in a real negative interest rate, we are going to be killing it. You know, another spot to look at is emerging markets. That might be another spot to look at because if they're commodity heavy and their currencies are going to get stronger against the dollar, I mean, emerging markets are going to do very well. Something like ticker symbol EEM. And I own emerging markets as well. And I own some of the banks over in India. Because I think if their currency gets a little bit stronger in relationship to the dollar, I think they're going to do very well based off of their demographics. So I chose some of the banks over there. HDB and IBN are the two that I own. Looking at this, it says, Andy, thank you, but to be up to date, please, wait till the end of the day and use updated charts. You have a serious YouTube channel, so you can afford to give your audience real-time information, and you can't do it if your charts are delayed and you make your report in the middle of the day. So I make my report right after the market closes. And having it be delayed a teeny bit's not going to matter. And for the most part, I'm not day trading. And if I missed a teeny bit of the move, it's okay, guys. It's not the end of the world. I know a lot of people think that you must have the most recent information on everything. And I'm going to tell you this, the news, it's not going to matter. All this news that comes out, unless it's like earth-shattering, structural changing news, the structural underpinnings don't change with the day-to-day news for the most part. This commodity boom will happen irrespective of what new information you have. And if you're trying to trade based off of like the most recent information, that's a very hard game. You'll find that out very quickly. I've been in the sector. Uranium hasn't changed since 2016. That's when the beginning of the bull market came for the majority of these commodities. It came in 2016. I played the bottom of the gold and silver market. I saw it. It was a falling wedge right into a corner. It broke in 2016. I think I bought First Majestic for like $2. And I rode it all the way up. And I actually sold it at the top as it started coming back down a little bit. And I think it did it all in 2016. It was the beginning of 2016. I think it was like February of 2016. January or February. About right in that corner, and then boom, it shot up. Had massive gains, too. It was massive. But that was the bottom of the bottom. That's when the real estate market started to really start to get moving. It started getting bigger increases in the real estate market. And I didn't figure out all this, I would say, the real estate market and housing starts till a couple years after that. But you guys, I mean, I understand that you want, a lot of people think that this news and listening to all these people, like, other channels or whatnot, and all the new news is going to change something. It doesn't. The markets move in cycles. They move in cycles. They go up a lot. Impulse moves. They pull back. It's the Elliott wave. It's the way that humans interact with each other. It's not. Some of it is news driven. Some of it isn't. Some of it's emotional. The emotions of people and how they're interacting. I don't really focus. I could literally probably go years without even reading a single news article and be just fine. All I would look at is supply, demand, inventory data numbers. Like if one person wants to be, if all you wanted to focus on is the market conditions, and you just focus on that, right? You focus on the ratio, which is your valuations, and you focus on the market conditions. You could block everything else out. You could not even really look at a lot of these charts in between moves. You could just say, okay, we're looking at the chart on a big long-term perspective. It is bottoming. The day-to-day movements don't even matter. You could look at a monthly candlestick. You could see it turning. You could see the ratios bottoming, and then you just buy the ratio and the bottom in the ratio. And so long that the market conditions are conducive for the move, everything else doesn't matter. The news doesn't matter. The day-to-day movements doesn't matter. And the reason I do all of this analysis on day-to-day is because everybody wants to see it. I am driven by, the channel is derived and made by the viewers of the channel. And I would say that the majority of YouTube, what people do, and it's not, I don't do this, but a lot of people, they will construct an entire YouTube channel based off of what their viewers want to watch. And that positive feedback through views and the money made and all that stuff is going to drive the decisions and the way that people interact with their viewers. It's going to drive it's going to drive the person a certain way. The more views someone gets, the majority of people are going to change their channel to get more views, because that's what the viewership wants. And I'm going to tell you this, the viewership and what it wants and the amount of views may not align to being a successful investor. So the person will be stuck between views and telling people kind of what they should do and what they should want to know and focus on. And if it doesn't align, you don't get the views. So now if you're a financial type channel, you're torn between what really should happen and your views and how much you get paid and all that other stuff through this channel, through not my channel, but just through YouTube, through viewing information on YouTube. And a lot of the information might seem boring to people. Like my lowest viewed videos are all on real estate. No one seems to like real estate. I think that real estate's the most important thing to understand. That is your market conditions. If real estate and the housing starts are doing well, your uranium can do well. Your oil can do well. Show me a time in history where oil's gone through the roof and you've had a decline in housing starts. It's never happened. Never, ever happened. The real estate market determines if your commodity market comes or not. With no real estate market, it won't happen. It hasn't happened in history. We have not had we've had stimulus money put into the system that has driven gold and oil up, like it did in 2009. They put a bunch of stimulus in the system. The money supply went up. We had a little bit more inflation, and that was it. It was not sustaining because the housing market was in a recovery phase. So whatever boom you get from it, it won't be sustained forever unless you have, or it won't be sustained because you don't have that housing start and that loan growth volume. So the most important thing, in my opinion, to focus on is the thing that is least viewed on this channel. I mean, just to kind of talk about views and all that stuff. The time that people want to buy, that should be buying the most, is when my videos are viewed the least. And it's just, I mean, to start a commodity channel, at the bottom of a market is very rough when it comes to YouTube, because if you're a good investor, you're going to be investing in all of the assets that nobody wants to view or listen to. I mean, think of it that way. Commodities are out of favor. They're becoming in favor, and this channel will do very well based off of the commodity cycle. But in the beginning, it's hard to grow a channel when nobody wants to view it. Everybody wants to learn about the things that are in a bubble. Crypto is really big. Crypto's in a bubble. That's where all the retail's at. Retail doesn't win. If you follow what retail does, you will lose continually. You'll just lose money. And I know some people get frustrated. They get impatient. They want their investments to work immediately. But they're just chasing gains. They just chase performance. That's all they do. In order to be buying at bottoms, you have to be incredibly patient, because what happens is it builds steam over time. And then you'll get a blow off top at the end. But everybody's looking for the blow off top all the time. It just doesn't happen that way. It gains steam throughout the boom. We've been booming for a while in stocks, and the beginning of that move was not a huge boom. It was real slow. But if you want to buy the bottom, you have to go through that slow growth. You have to go through the entire cycle. Now we've had a great opportunity to buy at the 2020 bottom, and some of these have gone quite fast because they came from such undervalued positions or undervalued spots. So we had a nice, good kind of bounce off that bottom, and now we're getting momentum to the upside. And when interest rates go up, I think we're going to really start to move. So it's a matter of like controlling yourself and just being patient. This stuff doesn't work super fast, and sometimes it does. Remember, when you get these impulse moves up, they move up very fast, and then they consolidate for a long time, or they pull back for a long time, for many, many months. But the move up was only, a few weeks or a month or two. And then you go into this 6-month pullback. I mean, it's very hard for people emotionally and from a patient's perspective to hold on to this stuff in any stock, because they're all like that. They move up really fast and then they consolidate for a long time. If you're a long-term investor, you're going to be living through a ton of consolidation periods, and then the big moves happen very quickly. If you don't get the big moves, and all you do is you buy it and you consolidate the entire time, it's going to be a rough life. Of course, you're going to be very frustrated. So you have to identify what's cheap, and it's going to feel like it's wrong because you're not chasing prices. You're going to buy at the bottom, then you got to hold on for a long time. I mean, that's what it is. It's a super long plane ride. And if you don't have anything to really do, it's pretty boring. And that's what investing is. It's boring. You just sit there and wait. So that's what I wanted to kind of cover here. And again, guys, I think that most everything is driven by financial means through interest rates and money flows. And if you see an entire sector moving, and sometimes the entire markets move together, they get kind of very well correlated with just money coming into the system. It's just all money flows. That's what I've learned over all this time. Hopefully you guys like the content. Give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.